Only objective questions. Which of the following exchange operations have been useful in treasury management operations? So, which of the following foreign exchange operations have been useful, okay, for treasury, useful in treasury management? So, treasury management is arbitrage and swaps. Now, you can definitely answer this here. Looking at this at the CAIIB level, you can definitely answer me. Yes, sir. Yes, sir. Yes, sir. Answer will be what? Let me see what is the comment section. In the comment, what are the answers? I know all of the answers will be what? C, right? All of the answers are C. I know. But the problem is, do we understand arbitrage and swaps? We have just heard the names. Do we understand this? How many of you understand this arbitrage? How many of you understand this swaps? Type yes in the comment section. And if you don't, kindly type no. Not an issue. I'll explain you both. Okay. Arbitrage also and swap also in simple language. Okay. What is arbitrage? Arbitrage is basically buying in one market. I'll write it simple. See this. Buy in one market and sell in another. Immediately. Sell in another. Immediately. Very important term is immediately. Okay. Immediately. This is an important term. Immediately. Because everyone does the same thing. Buy somewhere and sell somewhere. That's business. But immediately is an important part. Means I'll explain you one simple example. Suppose if I'm having, let's say in India, how many stock markets are there? How many markets are there in India? There are two markets, right? NSE and second is BSE, right? BSE. Okay. Many a times what happens, there is a difference in prices. For example, let me show you Infosys. Let's say Infosys. Okay. Infosys. If Infosys price on NSE is, let's say I'm taking example, let's say it is 1000. And on BSE at the same time, it is, let's say 1003. Now this difference on NSE and BSE remains for hardly, I'll tell you, 4 seconds. 4 seconds, hardly, not even 4 seconds nowadays. With the technology, it is hardly 3 seconds max to max nowadays. It immediately gets converted or collapsed. Okay, it matches with each other. Now, if I am the arbitrage person, what will I do? Do you know? I'll buy, let's say 1 lakh shares, 1 lakh shares. Okay, of Infosys here at the same time, right now. And I'll sell 1 lakh shares at BSE right now. Here I'll sell and there I'll buy. What happens? At the same, in hardly 4 seconds, I'll do all these jobs. My computers, my internet needs to be very fast in this. Okay. So what have I done? I've earned 3 lakh rupees. 3 lakh. See this, 1003. 3 into 1 lakh. This much I've earned in how many? 4 seconds. That is arbitrage. Buying in one market and selling in another market immediately. That's why arbitrage is the most important and the safest transaction. Safest. But it is safest subject to the timelines. If you are able to follow the timelines, then it's safe. If you are not able to follow the timelines, you are gone. Okay. So that is arbitrage. Now what is swapping then? Swapping, remember, only you remember one basic about swapping. Swapping means always, there are 2 legs in swaps. Always there are 2 legs. Okay. One is fixed and other is floating. Okay. Floating. What do you mean by this? Keep it very simple. Suppose I'll give you this example over here. Okay. So suppose if I take 1 lakh rupees from you, 1 lakh. Okay. And guarantee you 7% rate of interest. 7%. Here I am taking it from you. So I have to give you 7%. I have to give 7%. And what do I do with this 1 lakh rupees? I invest this 1 lakh rupees in the stock market. Now in this stock market, this 1 lakh rupees, I may get at the year end. Here 7% is for the year. So at the year end, I may get 25% returns also. Because after all, it's stock market. It can give you heavy returns. Or I may get 0% returns also. Or I may get minus 25% returns also. Negative also. Stocks might go down also. So this is what? This is floating. And this is fixed. So swap always has 2 legs. One is fixed, another is floating. Now this swap can be of various types. It can be currency swap, it can be interest rate swap, it can be any swap, commodity swap, anything. But logic remains the same, fixed and floating. Okay. And one more important term about swap is it's a exchange of series of payments. Series means, example, I'll give you RD. What is RD? Recurring deposit. It is a series of payment. I'll give you 1000 per month, and at the end of the year, you as a bank will give me whatever 12,000 plus that interest. Right? So it is a exchange of series of payment. Everyone got this? Swap and arbitrage. Very important terms. These are the derivative instruments. There are almost 7 derivative instruments, 7 to 8. That's why I'm saying join the classes, paid classes, because everything is not I won't be able to cover it over here. Okay. There are many others, FRA, forward, future. Okay. So we'll cover it in the classes. Okay. So now the answer is A and B both. You got it, everyone? Type yes in the comment section if you have understood it. Everyone. Type yes if you have understood it. Okay, move on. Chalo, next one. Risk in the trading securities may arise from the following activities. So risk in trading securities. Securities means what? It can be anything. It can be shares, it can be bonds, it can be anything. Forex, then equity holding, lending and repos, and all of these. So securities may arise, risk in this trading may arise because of what? It can be due to Forex also. It can be due to equity also. It can be due to repos also. The repo rate also keeps on changing. Right? So the answer is, what is the answer? Correct answer over here? Comment section. Answer is A, B, C or D? D. Correct? Risk in trading securities may arise from the following activities: exchange, equity, repos, all of these. Which of the following is not an agency service of the bank? Agency service. Okay, now this is a simple question. Extending credit, escrow, merchant banking service, and insurance selling. It should not be an agency service. You want not. Okay. Agency means what? In this product, the bank will get a commission without any risk. Look at this. Agency, the main point about agent is agent. Any agent. We see that LIC agents, we see this mutual fund agents. What is the rule? They have twofold rules. One is commission. They get the commission. Okay. And second is no risk. They don't have any risk. Agent's role is only agent. Agent just plays as a middleman between that company and you. So if tomorrow something happens, the agent will directly point out to that company. Go there and solve the issues. So no risk. So that's why when your bank acts as an agent, it also gets 2 points over here. Commission and no risk. So in which of them it is not the agency commission, means which is agency service, or which is the core banking service? Core banking service is this, extending credit. It is not the agency service. Escrow is an agency service. Escrow means what? It's a temporary account. Temporary account. It is opened generally when there is a project to be done between two companies. Okay, so that is an escrow account. Merchant banking services. So this is also agency service. Your bank gets a commission. Where do we get merchant banking services? We generally give this in IPO. It doesn't come to you at a retail level. It goes at a corporate level. Insurance selling. This comes to you. You also do the same thing, right? So not an agency service is extending credit. Everyone download Adda 24/7 app on your mobile. In this app, you'll be getting the premium study material, plus live classes, ebooks, tests, whatever we require for clearing JIB and CAIIB, you'll be getting it over here. Okay, so that's why download it right now. Okay. What is the off-balance sheet risk? Look at this, off-balance sheet risk. It is contingent in nature. It can occur on account of issue of guarantees, committed credit lines, and issue of LCs. Bank's commitment may happen on account of failure to meet the payment obligations, and all of these. So now let me get the answer from you first. What is off-balance sheet risk? Is this A or B or C or D? All of them. Yeah. Answer is, everyone, the answer is D, all of these. Okay, all of the above. Remember, off balance sheet means what? Which is not shown in the balance sheet. What is not shown in the balance sheet? Contingent liabilities are not shown in the balance sheet. Contingent. Okay. Now, what do contingent liabilities include? Contingent liabilities include bank guarantee, BG, LC, court cases. Court cases are also contingent liabilities. Okay, court cases. So these are the three main contingent liabilities. So off balance sheet risk means contingent in nature, can occur on issue of guarantees, and bank's commitment may happen on account of failure to meet the payment obligations by that party. Means, what do you mean by this third part? Third part means, suppose if my bank is giving the guarantee and if that other party does not perform, then my bank will have to pay, isn't it? So that's known as bank's commitment may happen. May happen means crystallization. This is called as crystallization. When the risk which you have just given in words, when it comes for payment, that is known as crystallization. So answer is A, D. Okay. Which of the following statements is correct? Always check the question. What do they want? Correct or not correct? Okay. The funding risk may arise from the need to replace the net outflows due to unanticipated withdrawals of deposit. Unanticipated. Funding risk means what? Funding risk means I may not have the regular funds which are required for my regular payments. Why? Because unanticipated withdrawals. All the customers of the branch come for withdrawal of money. All of them. So that is unanticipated withdrawal. This happens when? What is this term called as? When all the customers come to withdraw the money in the bank. All the customers. That is known as, one concept is there. That is known as what? Anyone? It is what? It is called as run on the bank. This is the important term, run. I'll write it over here. Run on the bank. Run, or they call it bank run. That's simple. Bank run. Okay. So this funding risk may arise due to this. Let's see. The time risk arises when the performing assets turn into NPAs. So my performing assets become NPA. So time risk means what? On the required time, I may not get the payment. On the required time, I may not get the payment. So that is time risk. Call risk arises due to crystallization of contingent liabilities. Just now we saw it. First, earlier question. If I give you a guarantee, let's say this is a bank. Okay, bank is, it is having one customer, contractor. Okay. Now this contractor wants some road, state government. It wants some road contract from state government. So state government will ask for guarantee. Okay, so bank gives the guarantee. Now this contractor does not build the road. Okay, does not perform. Then the state government will ask the bank for payment. So bank will have to pay. This is known as crystallization. So this is, which of them is correct? Call risk arises due to crystallization of contingent liability. That is also true. So the answer is what? Call risk, time risk, and funding risk. What is the answer? Isn't it? It's all of these. All of these, right? That is the correct answer. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates on JIB and CAIIB from IIB. Number one, there are two things which you will be getting. But first is this updates. Now, what are the updates? Updates can be like, for example, change in venue on the last moment. Change in the date of the exam on the last moment. Some change in the portion, last moment. Type of questions change, last moment. IIB gives regular updates, okay, at the time of exam. So for that, you should follow this Officers Adda 24/7 YouTube channel. You get it over here. So first one, updates, you get updates. And second is free YT series, YouTube series. Okay, second is YT, free YT. Right now, what are you watching? Free YT series. Right now, you are watching the same free YT series, YouTube, right? So similar YouTube series, you get it on all the subjects. Okay, so that's why subscribe to this channel, click on the bell icon. How to do this? See this. We have 3 to 4 channels. I would suggest you join all the channels. One is on Telegram. Scan this blue code. Scan it right now. One is this black code. That is for YouTube. Okay. Then third is Instagram. Scan this Instagram code also. And there is one more, that is WhatsApp channel. Nowadays WhatsApp channel have started. Do you know? How many of you know that WhatsApp channels have started? Type in the comment section yes. How many of you know that WhatsApp channels have started? In the comment section, type yes, everyone. How many of you know this? WhatsApp channels have started. Do you know it? So, yes, WhatsApp channels have also started, and we are already there on WhatsApp. Okay. So just type Adda 24/7 on WhatsApp and you'll get it. Okay. Next one. The features of interest rate risk are. Features of interest rate risk. Interest rate risk are. It is an exposure on the bank's financial condition to adverse movements in the interest rates. So exposure on the bank's financial condition to adverse movement. So exposure for adverse movement. If the things are going against me, then it's an interest rate risk. Obviously, if the rate of interest is going against me, then it will be a risk. If it is going in favor of mine, then no risk, isn't it? It has no effect on the net interest margin. No effect. Okay, it has no effect on NIM, net interest margin. What is NIM? What is the formula for NIM? Everyone type in the comment section. Do you know what is NIM? Formula for NIM in the comment section. Yeah, it is NII. NII divided by NII divided by assets, performing assets you can call it, or just call it assets also, it's okay. Performing assets, that's the right word. NII upon performing assets. Now what is NII then? NII means this interest, I'll just write it short. Loan interest which I get. Here, loan interest I receive minus this deposit interest. Deposit interest. So that difference is known as my NII. Okay, that is my income, isn't it? This is my income of the bank. How does the bank earn? Bank gives loan and gets interest, and takes deposit and gives interest. The difference is the income. So that is NII. This NII, when I divide it by the performing assets, I get NIM. So no effect on the NIM. It may not affect the market value of the equity. It may not affect the market value of the equity and all of these. What is the answer? All of these? Because all the answers earlier were all of these, and that's why this also all of these. Don't follow this concept in your CAIIB. CAIIB is not all of these, none of these. It's not compulsory that these answers will be there. The correct answer over here is A. It is an exposure to bank's financial condition to adverse movement in the interest rate. It has an effect on NIM. It may affect the market value of the equity. Okay, that is the point, correct one. Which of the following is not a mismatch risk? Mismatch means what? Mismatch. Let's see. Okay, and we want not. Okay, this is your important question. Not a mismatch risk. Holding assets and liabilities with different maturity dates and amount. So assets and liabilities with different maturities means I am having deposit of 1 year and loan of 3 years against that deposit. Okay, deposit of 1 year for 1 lakh, let's say 1 lakh, and I am having a loan for 3 years for the same 1 lakh. So it will be a mismatch. So I want not a mismatch. Is this a mismatch? Okay, just type in the comment section yes or no. Is this a mismatch? Holding assets and liabilities with different maturity dates. Is it a mismatch? Yes. So it is true. I want false here, not. I want false. So this is true. Now what about the second one? Adverse movement in the interest rate. So adverse movement. Okay. So adverse movement in the interest rate means due to in the loans and the deposits. If the interest rate moves in the adverse movement, then definitely it's a risk for me. Third one, let's see. B, keep it on hold because it can be the answer. When the liability is repriced on the maturity date and this causes variation in the interest rate. Now, is this the point? Means liability this is repriced on the maturity date. So repriced on the maturity date means what? When I am having the maturity, this liability means what? For the bank, what is the liability? Liability is the deposit, right? So this deposit is repriced. If the deposit goes against my favor, if the deposit interest rate has increased, so that there will be a mismatch between the interest rate of the loans as well as on the deposit. So my NIM will affect. NII will be affected, and in further to this, NIM will be affected, net interest margin, right? So this is definitely a mismatch risk. So this is also true, true. This is also true, but I want false. So now we have to check the closest false. All of the above is not possible because these are not the mismatch. These are the mismatch risk. So A and B are the mismatch risk. So all of the above is gone. So which is the nearest one? Adverse movement in the interest rates. So this is not the mismatch risk. Now what is the logic behind this? You will say, sir, it can be the mismatch risk. Yeah, I have told you it can be. But I'll tell you how to explain this. See this. If loan, look at this, everyone pay attention. Loan, okay, and second is deposit, okay. Now, if my loan rate is, let's say 9%, and my deposit rate is, let's say 7%, then what is my NII, net interest income, NII? My NII is 2%, 9 minus 7, 2%. Now, imagine both of them go down. Both of them decrease. So both of them become what? 8%, and this becomes 6%. Same proportion. Then also my NI is 2. Okay. So that's why it is said over here, adverse movement of the interest rates is not a mismatch risk because it is happening in both of them. Now, if it happens in one of them, means this decreases but this does not, or this decreases, this does not. In that case, that is called as a basis risk. Basis. Okay, in basis risk, then you will be having the mismatch part. But here is anything mentioned about the basis risk? No, it is mentioned adverse movement in the interest rates. So it is for both. So that's why this is a false answer, and it is not a mismatch risk. Okay. What is the yield curve risk? When two different instruments maturing at different time horizon for pricing assets and liabilities. So different instruments maturing at different time horizons. So that is the yield curve risk. Yesterday I had given the details about this yield curve. Follow yesterday's video. There may not be parallel movement in the interest rate of both the instruments. That is also true. Means 10 years bond. Here, example. 10 years bond will change in different proportion. Whereas to 1 year bond will change in different proportion. Interest rates. Okay. Non-parallel movement in the yield curve may affect the NII. So that's also true. Non-parallel movement means this is changing differently, this is changing differently. So net interest income will be affected. So the answer is all of the above. Okay. So let's move on immediately. Okay. Today I'll be covering different yield curves, types of yield curves. Okay. And then the questions on that. Very important part from your exam perspective. Yield curve. There are 4 types of yield curves. Always remember. Yield curves, one is this normal yield curve. Normal means what? Let me explain you this. Suppose if you keep a FD, let's think of FD only. FD. You keep a FD of 3 months. 3 months. Okay. And then I keep an FD, let's say me. I keep an FD for, let's say, 8 years. Okay. 8 years. FD, what is maximum FD available? Up to 10 years. Okay. In banking. So you keep the FD for 3 months and I keep the FD for 8 years. So if you are getting the FD rate of interest of, let's say, 3.5%. Okay, you are getting an FD rate of 3.5%. What do you think I should get this rate of interest? Should it be more than 3.5? I'll write it more than 3.5 or equal to 3.5 or less than 3.5. Less than 3.5. Okay. So what should I get? What do you think? More than, equal to, or less than? I'm keeping it for 8 years, and here I'm keeping for 3. You are keeping for 3 months. So I'll be getting it for more than 3.5. Correct. I'll be getting more. Why? Because I'm keeping the money for the higher period. Okay, larger period. Right. So this depends on what? Keynes theory. Remember, Keynes theory is there. It says that the more you part with your money, the more are the returns expected. Now look at this curve. This is the maturity period and this is the yield. So this is 3 months over here and this is 10 years over here or 8 years over here. So that's why if you look at it, the rate of interest over here is higher. The rate of interest over here is lower. Now apply the same logic to bonds. Bonds with the lower maturity will have lower interest. Bonds with the higher maturity will have higher interest. This is a normal yield curve. Now this is possible when here we assume something. What do we assume? We assume that the country will grow upwards. Getting this point? If my country is growing upwards, only then this is possible. If my country is going into recession, then it will be exactly reverse. The FD rate, the bond rate for 3 months will be higher and bond rate for 10 years will be lower. This is known as inverted yield curve. Inverted yield curve is a sign of recession and normal yield curve is a sign of good growth. India is presently over here. Many of the Western countries, including USA and UK, they are in this phase right now. They are going towards this. Okay? They are artificially keeping the economy running over here. Artificially right now. We won't go into those details because it's a huge topic. Remember, just if anybody wants to check, just check the yield curves for USA and UK in last year from June 22 to December 22, and then you'll understand everything. Right now they are in this phase, going in this phase, recession phase. That's why their yield curves are slightly inverted. They have kept it going right now. They have kept it around this flat or to the other extent to this upper level, but they can hardly sustain for some time. 1 year, 2 year, 3 year, that's it. Okay, now what is this flat yield curve? Flat yield curve means country is not growing at all, not going down, not going up. Flat. 3 months rate of interest will be same as that of the 10 years rate of interest. Humped yield curve. This is called as humped. Humped means what? There is a slight growth in the initial period, but later again recession. So this is known as transition. Okay, transition means what? It grows in the initial years and then it transits to the lower growth phase. So recession phase. Here it is recession, here it is growth. So these are the 4 yield curves. In exam, mostly they will be asking you 1, 2, 3. Because this is transition, recession. Generally, this recession is asked more. Because why? This is only the typical one which is followed throughout the world. Okay. Now let's move on to the questions. When the upward sloping yield curve will appear, means when an upward sloping yield curve will appear, means upward means just now we saw this one. When will this appear? During the times of expansion, when the recession occurs, during economic transition, when long-term interest rates are lower than the short-term interest rates. Long-term are lower than short-term. So when will this occur? In the comment section. I want it in the comment section. A, B, C or D? It is during the times of expansion. A. Okay. Now tell me in B, C and D. Okay, B, C and D. There are 2 options. Now look at this question. There are 2 options which are same. In B, C and D, there are 2 options which are same. Now, which are those options which are same? B is what? Recession occurs. B means recession. C means economic transition. So this will be what? Humped curve, camel humped, right? This is this camel humped curve. It will be like this. Okay. This just now we saw this. What is D? Long-term interest rates are lower than the short-term interest rates. Means what? See this. Long-term is lower, short-term is higher. So it will be like this. Now if this is like this, then what is the recession? Recession is also the same. That's why B equals to D over here. Okay. It just I got it. The thought got into my mind. That's why I asked you. Okay. So upward sloping yield curve in the expansion, and recession means long-term interest rates are lower than the short-term interest rates. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests. Whatever we require for clearing JIB and CAIIB, we get it over here. Okay. Define the flat yield curve. Flat means, just now we saw that short-term bond rates are equal to long-term interest rates. Okay, so basically short-term rates equal to long-term. I think that is the answer or no? Let's see. Short-term interest rates are greater than the long-term. Short-term greater than long-term. So can you plot these curves? Okay, let me plot these curves. See this. Short-term equals to long-term. So this is flat over here. B1. Let's plot this B. Okay. Short term are greater than. So short term greater, long terms lesser. So it will be like this. Recession. Long term interest rates are greater than short term interest rates. So this C will be long term greater than short term. So it will be like this. Normal. Small companies provide greater yields than large company stocks. This has no base at all. There is nothing called a small company providing higher yields or higher returns. What is the yield? Yield means asking rate. Asking. Always remember. Demand. Rate in demand is yield curve. So it's nothing like this. Okay. So the answer is A. Okay. How do you define economic transition? Transition means that camel humped curve. Okay. Transition in an economy from recession to expansion. Okay. Transition in the economy from expansion to recession. None of the above two answers are correct and both are correct. So what is this? Recession to expansion. See here, A. Let's plot this curve of A. Recession to expansion. Recession means it will be first like this. Recession means inverted curve, right? To expansion. So it will be like this. So what is this? Again, it is a hump. Look at this. It is hump somewhere. Okay. So this is also true. From expansion to transition B1. Let's plot this B. So expansion to recession. So this is also true. So both are transition curves only. So both the answers are correct. Okay. Now how to join this Officers Adda 24/7 YouTube channel? Well, for joining this channel, scan the QR codes. This blue is for Telegram. Black is for your YouTube. Click on scan this. Okay. Then this one is for the Instagram. And how to join the Instagram, this YouTube using these codes. And there is a separate channel on WhatsApp. So you can join this WhatsApp channel also. Just type Officers Adda 24/7 on WhatsApp. You'll get it. Okay. On WhatsApp channels now. There is a separate option of channels. Okay. A yield curve that shows down-sloped curve is what type of curve? Down-sloped. Now this is easy. Normal yield curve, flat yield curve, inverted. All yield curves show down-sloped curve. Is this all yield curves show down-sloped curve? What do you think? The answer is normal, flat, inverted, down-sloped, down. It will be inverted. Okay, inverted yield curve will show down-sloped curve. A yield curve that shows upward direction and which long maturity bonds have higher yields is known as. So if any yield curve is showing upward direction and long-term bonds are having higher yield, just now we saw it, isn't it? What is the answer? A, B, C or D? Type it in the comment section. Correct? Normal. Okay. Which of the following statements is false? A forward exchange rate is a good predictor of the future spot market. What is this? Forward exchange rate is a good predictor of the future spot market. Future. So forward rate is can predict the future spot exchange rate. Predict. Okay. A forward exchange rate and a future spot market may not be the same. So forward exchange rate and future spot market may not be the same. Okay. A forward exchange rate is an unbiased predictor of the future exchange rate. So forward exchange rate is an unbiased predictor of the future exchange rate. Okay. The spot exchange rate is a good predictor of the future exchange rate. The spot is a good predictor of the future. So we want what is false. What do you think is a false answer? Firstly, you should know what is true answer. Remember, nothing is over here in this question. It's just forward and future. Forward exchange rate is booked today. for 2 months later. Okay, and future spot rate is the actual rate 2 months later. So that is basically the future spot rates. Here, just I'll explain you in simple terms. Today is what? Let's say any date. Okay, let's consider 1st January. Okay, Jan 1, let's say. Today Jan 1. Okay, now I book a rate today for dollar and I book it for, let's say, March 1. I book the rate for March 1. Okay, so now understand what is forward exchange rate and what is future spot exchange. When I say forward exchange rate, I book this rate today for March. So this is known as forward because I have booked it today. Okay, forward exchange. So this is forward exchange. Now what is future spot exchange? It means that actual rate on March. Actual here, if I have booked this rate today for March, let's say at 80 rupees 75 paise. Okay, if I booked it at 80.75. But actually on this date, it goes to, let's say, 83 rupees. So this is known as my actual future spot exchange, and this rate which I book it today for the future is known as forward exchange. Now remaining things you can definitely get it. Okay, future spot, same thing. Forward exchange, same thing. So which is the false one? Where is the answer? I didn't get the answer. Let's call this A, B, C, D. A, B, C and D. What is the answer? We want false answer. It is D. D is false answer. Spot cannot predict future. Only forward exchange rate can predict future. Okay. The objectives of central bank include. What is the central bank? Central bank means not Central Bank of India. It is RBI. We are having a separate bank called as CBI, Central Bank of India. Okay. So the objectives of RBI include to ensure country's balance of payments remains in equilibrium, to accumulate the country's foreign exchange reserves, to ensure the implementation of country's exchange rate policies, to control international trade. What should be the answer? RBI's main role is what? Ensure country's balance of payment is in equilibrium. Accumulate foreign exchange reserves. Accumulate means go on accumulating the dollars. To ensure implementation of country's exchange rate policy. Okay, implementation of country's exchange rate policy, and to control international trade. See here, nobody can control international trade. That's out. Accumulate is out. Now the question is only between A and C. Ensure country's balance of payments is in equilibrium, or ensure that implementation of country's exchange rate policy. See, this implementation depends on individual banks. Whatever policy is there, that is done by individual banks. Okay, that is not done by RBI. RBI gives the policies. So the answer is A. To ensure that country's balance of payment remains in equilibrium. Subscribe to Officers Adda 24/7 YouTube channel. Just now I told you how to subscribe to it. You can subscribe it on the YouTube also. You can scan the QR codes, okay, and do it. Because you will be getting various free YouTube series. All these. Right now you are watching the free YouTube series. You get it over here, okay. The exporter should necessarily submit the export documents to the bank within 15 days from the date of documents, 15 days from the date of shipment, 21 days from the date of documents, 21 days from the date of shipment. Now what is the answer? Let me see how many of you can answer this. Yeah. 15 days from the date of documents, 15 days from the date of shipment. Okay, from the date of, what do you mean by shipment date? Shipment. What is the shipment date? Shipment date means whenever you get that bill of lading, on that there is a stamp called as shipped on board. Shipped on board. On board. Okay. This shipped on board stamp, whenever, whatever date it has, that is known as the date of shipment. So this exporter has to submit the documents to the bank. It's not, actual word is not bank. It is called as AD, authorized dealer. Okay. So the exporter has to submit the documents to the AD within 21 days from the date of shipment. Remember, 21, and these days are calendar days. Remember, 21 calendar days. There are 2 days in banking. One is calendar, second is banking days. Banking, whenever banks are open. Okay. The multinational company encounters the following exposures to foreign risk. So any MNC will encounter which type of risk? Translation, economic, transaction, and all of the above. What is each risk? What is translation risk? Translation risk means what? Suppose if I am, let's say, SBI. Okay. Is SBI a multinational company? Type yes in the comment section. Is SBI a multinational company? It is fine, because multinational means which has the branches or offices in more than one country. So SBI has various branches in outside also. Okay. So let's say SBI is having a USA branch, and this USA branch is having some profit. Let's say $1 lakh. It has a profit. Okay. $1 lakh. Now this $1 lakh has to be brought to India, not physically. Whenever on 31st March, SBI has to report its balance sheet to RBI. So while reporting it, it will also report the balances or the profits of its subsidiaries which are in foreign. But those will be reported in rupees, because RBI follows rupee system. So this dollar will be converted to rupees notionally. That is known as translation exposure. Whenever I convert this notionally, whatever notional profit I have or loss I have is known as the translation exposure. Economic exposure means basically economics related to financial. Transaction exposure means related to transaction, settlement. Mainly this will be settlement exposure. Okay. So any MNC will see what type of exposures, all of these, isn't it? The role of hedging agent is, means what is hedging actually? What do you mean by hedging? Anyone? Type in the comment section, what is hedging? Hedging means, yeah. Hedge. Buy in one market and sell in another. Suppose let's say there is a Reliance share, Reliance, okay, and in NSE, let's say it's running at 2,500, and in BSE, it is running at 2,503. Now this change happens only for 3 to 4 seconds, 4 seconds only, not more than that. So within these 4 seconds, the whole game is played. So I'll buy 1 lakh shares over here and sell 1 lakh shares over here. Sell. Here I buy. What does this mean? I'll do it in 4 seconds. Buy here, sell here. So I earned 3 lakhs over here in 4 seconds. But what is the risk? If I delay in this, I'm gone, because this will automatically catch up with each other. So what is the role of hedging? Forget this agent. What is the role of hedging? Assist the firm in determining which foreign exchange transactions should be hedged. So here, depends on which currency or which commodity you are hedging. There should be enough liquidity in that. Liquidity. If there is no liquidity, then there is no logic of hedging. Hedging is always done in liquid stocks, liquid commodities. So which is to be hedged? So that should be decided. That should be supported by the team. Whichever agent's team is there, it should support that. A. Assist the firm in determining the types of currencies or interest rate swaps. So how should I hedge it? See here, what is to be hedged? First question is what? What is to be hedged? And second is how. So any hedging agent's job is answering these two questions, what and how. Okay. So answer is what? Over here. Answer is C, both A and B, isn't it? One for your homework. When the economy is moving up or down in a period of transition, what type of yield curve you will find? Economy is moving up or down in the period of transition. Remember, we are talking of transition. Then which type of curve you will see? Normal, flat, inverted, or humped? Answer it in the comment section, and tomorrow we'll see it. Okay. So let's start with this first one. Let's see. Here. The USD INR rate is 48.10 and pound to USD rate is 1, only 1. What is the rate of pound to INR? Now first tell me, what is this chain rule? Which rule will we use over here? The rule which we'll be using is See here, whenever we want some rate which is not given, is pound to INR rate given? What is pound? Pound means we call it GBP. GBP. I don't call it GBP. Great Britain pound. Is there anything great about Great Britain now? We are bigger economy than that Britain now, UK, right? India is a bigger economy than UK. Then what's great about it? I'll just call it pound. Okay? Yeah. So USD to INR rate is 48.10 and pound to USD rate is 1. What is the rate for this pound to INR rate? Now the question over here is will be using the which rule? Type in the comment section. It is called as chain rule. Chain, correct? What is the chain rule? Chain rule is pound, it's written as like this, pound to INR we want it, rupee, right? So pound, you had this in JIB, no? How many of you remember? You had this in JIB. Type yes in the comment section if you remember this. Yeah, it is. Pound to dollar will bring in a common currency over here. Pound to dollar. See here, we want pound to rupee. So pound to dollar into dollar to rupee, right? In the comment section, everyone. Type the answer now. See this, pound to dollar. Do we have pound to dollar? See this, pound to USD given 1. So it is 1 into dollar to rupees. What is the dollar to rupees rate given? 48.10. 48.10. So what is the answer? Same, 48.10. See this, D. Isn't it? D is the answer. Right? So this is called as chain rule. Always remember while solving any forex, the important part which is remains in CAIIB is after you get this rate, you have to either add or subtract the margin. Add or subtract depending on the transaction. Add or subtract the margin. Which exchange margin? Remember, this is up in JIB you had the problem up to this much only. In CAIIB you have the exchange margin also. So this exchange margin you have to either add or subtract it. Now how will you decide whether to add or subtract? You will decide it based on the basis of, suppose if you are selling, suppose if you are doing sale means what? When will you sell? You will sell it in import transaction. Suppose if you are doing the import transaction or sale, right, then you will be adding the exchange margin, add. Okay. It's not asked in this problem, but in exam they'll definitely ask you. They'll ask you some margin like TT margin is, let's say they'll ask you 0.15%. Now find the rate. TT margin is 0.15%. So what will you do? This rate which you get, now you'll first find out the TT margin, 48.10 into 0.15%. This is what you'll have to find it out. Okay. So multiply this. Okay. Let me solve this problem only now, right? Because in CAIIB you get higher level problems. These problems you get it. So 48.10. What is the answer you are getting? Into 0.15%. Percent means divided by 100. So it will be 0.0015. So what is the answer you are getting, guys? What is the margin which is what is the margin you are getting in rupees? So 48.10 into 0.0015. See this, 0015. Okay. So this answer, type in the comment section. What are you getting it over here? In the comment section, it is 0.072. Now what will you do with this margin? This is your margin in figure. This was in percentage. Now it is in numericals. Okay, number. So what will you do in this problem? So what is it given? USD INR rate is given, pound. What is the rate you will be taking? So it's not given whether it's a buy or sell. So let's assume it's a import transaction. Import. Okay, import. Right. So you'll sell it over here. In exam they'll be giving clearly import or export. So import means sell. So you'll have to add this. So what will be your final rate? It will be 48 point. Add this 48.10 plus 48.072. Add this, everyone. Answer which you will be getting is 48.1. Then what? 172. This is the final answer you will be getting if exchange margin is given. If not given, then 48.10. That's simple. Okay. Clear, everyone? Type yes in the comment section if you have understood it. Type yes in the comment section if you have understood it. Okay. Chalo, next one. USD INR rate is 48.10 and JPY USD JPY rate is this much. It is point over here, 91.50. What is the rate of INR to JPY? Now again, see here, what are you doing? You are again using the chain rule. Calculate the rate for 100 JPY. See this, 100 JPY means always JPY is calculated in terms of hundreds only. We never get the rate for 1 JPY and then keep it as it is because it's very small. But for getting this 100 JPY, we need to get first 1 JPY rate. So again use the chain rule. We want INR to JPY. Look at this, INR to JPY. Here JPY is below, right? So INR to JPY. So what is my INR to JPY? Rupee to JPY, right? JPY. Yen is written as like this. Yen and 2 lines, okay? Rupee to JPY equals to, so you'll get it what? Rupee to, I think so it should be JPY to INR, okay? Because we never get this, India never follows this indirect rate system. Let me make the change because you should get it JPY to INR. You'll never get it JPY, INR to JPY, okay? Because we never follow the indirect rate system. We follow the direct rate system. What is direct rate system? In direct rate system, rupee is always moving and other currency is constant. So India follows that system. Okay. So JPY to INR it will be, I'll write it simple. So JPY to INR equals to JPY to rupee, JPY to dollar into INR to, dollar to INR, right? Dollar to INR. So now what all do you have? JPY to dollar do you have? See here, you have USD to JPY, 91.50. So dollar to JPY you are having. Now you want JPY to dollar. So you'll just reverse this. So it is 1 upon 91.50. See this, it's reversed, right? Because it's dollar to JPY and we want JPY to dollar into dollar to INR. It is 48.10. Now take the answer. Now the answer will be, everyone do it, 48.10 upon 91.50. What is it? What is the answer you are getting? 48.1 upon 91.5, right? 91.5. Oh, did I write 8? 91.5. Okay. So it is 0.5256. 0. I'll write it below. Okay. So 0.5256. Right? So this is 1 JPY to INR. 1 JPY to INR. But what is asked over here? They have asked 100. So 100 multiply this by 100. So 100 JPY to INR equals to, multiply this by 100, 52.56. 52.56. So this much is the answer. So 100 JPY equals to 52.56 rupees. Remember. What does this mean? You must understand this first. 100 JPY equals to 52.56 rupees. Okay. So what does it mean? Rupee is stronger than JPY. If I ask you, okay, let me ask you this question. 100 JPY equals to 52 INR, let's say. Forget this 0.56. Now tell me who is stronger? JPY is stronger or rupee is stronger? 100 JPY equals to 52 rupees. So who is stronger? Rupee is stronger, correct. Rupee is stronger. In the comment section, rupee is stronger, correct. But remember now, it doesn't mean if any currency is stronger, like rupee is stronger over here, but does it mean India is more developed than Japan? No. We are the 5th largest economy. Japan is almost the 3rd largest economy now. Third or 4th. Germany and Japan, they both are in this fight. We are planning to surpass them in the next 3 years. Both of them. So that's why remember, even though Japan is having the lower currency, then also Japan is a bigger economy than India. Okay. So the answer is what? 52.56. Which is the nearest one? 56. See this one, D. D is the nearest answer. Okay. 52.56. No, 53. Sorry. 52.40. Take this. Okay. In exam, they won't give you such closest answers. Okay. 52.40, 52.80. They'll never give you the answers like this. One will be 52.40, second will be 55 something. Okay. There'll be a huge difference. So you'll be able to Immediately identify, because these points hardly make any difference. Okay, so got the answer everyone? Clear the concept? Shall I move on? Type yes in the comment section if you have understood it, and we shall move on. Okay, next one. When the exchange rate is fixed by the monetary authority of a country, it is called as by the monetary authority. Remember, monetary authority means RBI. RBI fixes it. Nothing doing. Dollar to rupee rate is today 79, so 79 only. There is no fluctuation, no demand, no supply, nothing. So, when the exchange rate is fixed by this monetary authority, it is called as what? Direct, indirect, floating, or fixed? It is fixed rate. Correct? It's fixed rate. Where do we have this fixed rate? Do we follow in India this fixed rate system? What do we follow in India? Do we follow fixed rate system, everyone? What do you say? We never follow fixed rate system. We follow floating rate system. Floating means, see, two things you always remember. In India, we always follow, one is direct rate system and second is floating rate system. Direct means rupee is fluctuating, dollar is constant. Okay, and floating means it depends on the demand and supply. Then in which country is this fixed then? Which country says it's fixed? Fixed rate. Fixed rate is hardly in any country now, but then also North Korea, you have this fixed rate system. And there are some minor countries, okay? Even China, I'll tell you, China is also, it's a quasi-fixed. I mean, they are following fake system. I'll tell you, fake. Why? Because they say they are following floating rate system. Floating rate means what? It depends on demand and supply. Demand and supply. Okay. But what happens? The Chinese government interferes heavily in this yuan. Their currency is yuan. Y-U-A-N, yuan. They have two currencies. One is yuan, second is renminbi. We don't hear about this renminbi many times. We hear about yuan. Both are equivalent only. 1 yuan equals to 1 renminbi. That's what I'm saying. They are playing the gimmicks over there. We are not going into that geopolitical issue now. But government or the central authority interferes in this and reduces the rate whenever they want, increases the rate whenever they want. They have done this in last 5-6 years. They have done it one night automatically, means one day suddenly the Chinese bank decided that reduce the yuan rate by 7%. Who, why, when, don't know. This is known as fixed rate, means quasi-fixed rate. Okay. Some other countries, like I gave you North Korea, there are some other minor countries are there. Bernoulli, no, what is that called as?